Welcome back to another episode of Global Insights for Tax Leadership, your go-to video series for relevant topics impacting the tax profession. Again, whether you're a seasoned tax professional or simply someone looking to better understand the complexities of the tax world, this series is designed with you in mind. We just released our inaugural episode, which covered generative AI. If you haven't checked it out, please do. You can find it on LinkedIn or on the KPMG YouTube channel. This episode is going to cover a topic that continues to evolve in a number of ways, and that's Pillar 2. I'm Jeff Burns, a lead tax partner in KPMG's Business Tax Services practice. And with me today, I have Alecia Kohorst, a partner in KPMG's International Tax practice, also based in Chicago. Alecia, thanks for joining me today.
Glad to be here, Jeff.
So I want to start with the first topic being some of the disruption we're seeing as it relates to global tax reform and Pillar 2. And would love your perspective on some of the retaliatory measures that are being introduced from a U.S. perspective currently.
Yeah, and I think an interesting place to start is to maybe take a step back to understand why the current administration is retaliating and taking some of these measures. So when you look at Pillar 2 overall, it's a global minimum tax that seeks to top up low tax jurisdictions. You look at the US tax rate, you see 21%. That doesn't feel low tax or below 15. But if there's some US multinationals that have claim an R&D credit or just have other tax fact patterns that put them at a lower effective rate, they're at risk at getting topped up by another jurisdiction. So the current administration came in and day one started signing executive orders, right? And the executive order, in particular, President Trump's America First trade policy, basically gives the Treasury 60 days to look at Pillar 2 as a whole and say whether it falls underneath Code Section 891. Code Section 891 has been around since 1934, but it's never been invoked by any other president. And what it seeks to do is just double the tax rate on foreign resident individuals or foreign corporate resident taxpayers. So it has limited applicability, but it's still a tool we have in our toolbox. And interestingly enough, we're coming up on that 60 days today.
Perfect. And what do you think when we talk about some of those retaliatory measures and the thought process around it? How's that impacting non-U.S. jurisdictions and their determinations or adoption of Pillar 2 as well?
Yeah, so great question. And it's not clear whether or not the executive order is just meant as like a leveraging tool in negotiations. And the thinking is, well, could we possibly be angling, could the U.S. administration possibly be angling for a permanent exemption for U.S. U.S. multinationals? There's currently a transitional safe harbor for the UTPR, which would top up many U.S. multinationals. And that in particular, if that was extended into permanent relief, that's some path forward we see. But otherwise, as it relates to rest of world, Pillar 2 has been adopted in 60 plus jurisdictions, and in many of those already enacted. And so there's various components to it. How it will apply to U.S. multinationals is still an evolving space. But in 2024, there's already jurisdictions that, apply a top-up tax, and the compliance is due in 2026. So as much as the U.S. has a big piece in how Pillar 2 will evolve and get rolled out, it still is very much here to stay and enacted legislation, and something that clients are focused on bottoming out both their safe harbor calculations, all three. Their safe harbor calculations, their top-up taxes where applicable, and then ultimately their path to compliance.
Perfect. That's helpful. So in closing, the last question I want to ask is, it may be a bit difficult to answer, but just, where do you think we're headed? And maybe more so, what's one thing organizations should be doing right now to prepare for any potential other changes or other disruption as it relates to global tax reform and Pillar 2 as a whole?
Yeah, no, that's a good question. So, Pillar Two, with respect to Pillar Two legislation, I would say stay the course, especially where you have enacted jurisdictions. Make sure that you're compliant, both managing your safe harbors and running your top up calculations where necessary. I think a lot of clients get through their safe harbors and say, phew, we're done. But you still have to file a Globe informational return, even if you meet a safe harbor for every jurisdiction. And that is coming due in 2026. So, better to look at that now while the numbers are close at hand than to wait a year and start scrambling to get that return together. So that's the first piece. I'd also say watch what the current US administration is doing, because there's other retaliatory measures they have been considering but that haven't been enacted. So there's been discussions around using BEAT as a retaliatory measure, the base erosion anti-abuse tax. And if that was to come into play, some US multinationals are subject to BEAT based on foreign tax credit utilization or other attributes that they're using. So that's not something that just applies to inbound companies. And it's something to watch out for as legislation evolves.
Perfect. Well, Alicia, thank you again for your time. I really appreciate it.
Yeah, no, it's been nice talking with you, Jeff.
And I want to tell everyone else, look for our next video series where we'll be discussing accounting for income taxes, including ASU 2023-09 and the related disclosures. So thanks, everyone, and have a great rest of your day.